about which part you look at, whether you want to look at the 710s if it gives you some insight, then look at the 710s. If you want to look at the 10s, 30s, look at the 10s, 30s. If you want to look at the 20s, 30s, look at the 20s, 30s. I look at all of it, to be honest. I look at all the different pieces. But when the 2s, 5s is out of line, of course, there's not an awful lot of point in me looking at the 20s, 30s because it's going to be the same as the 10s, 30s in terms of stories. So when most of my information is requiring me to look at the 2s, 5s, I want to try and find some overlap of the 2s, 5s, right? It's one of the ways that I can try and determine whether the 2s, 5s is right or wrong against everything else, because obviously the 2s, 5s working its way out should be a gradual, slow process. So the 2s, 5s to the 5s, 10s could be quite significant at times, and that's what we see when we analyze the 2s, 5s to the 5s, 10s. We can see sometimes it can be almost a negative correlation, at times, of course, a negative correlation, and this is the kind of thing we're seeing. But when does the 2s, 5s start moving towards the 5s, 10s? When it is a negative correlation, when we start seeing it becoming negatively correlated. When do we see it starting to move? Well, it must move through the curve, surely. So in other words, the last to move, one would imagine, would be something like the 1s, 2s, followed by the 2s, 3s, or the 1s, 3s, followed by the whatevers, followed by the whatevers. Now, obviously, going out the other way, beyond the 2s, 5s, the next thing that must move would be, you would imagine, the first thing to move in line with the 5s, 10s would be then the 3s, 7s. Would that be reasonable? Well, it should be reasonable. So for us to get to this point here, the 3 7s must start moving towards something. If the 3 7s still favours the 2s, 5s, that's suggesting perhaps that the 5s, 10s is going to have to come down a little bit, because part of the 5s, 10s is the 7s. So obviously if we've got weakness in the 3 7s, it would suggest that there's maybe a definite overbite on the 5s, 10s, right? So one of the things that I look at is the 3 7s to see if it starts to move back towards that 5s, 10s. That's that overlap that I was talking to Reeve about just a short while ago. So if we look at the 3 7s, one of the things you'll be able to start recognizing is those times where it does start moving towards the 5s, 10s. Let's analyze to see when that happens. So let's just analyze these two lines together. I'll change this to green. That stands out now. Okay, so when we look at that chart there, we can start to recognize, for example, the 2s, 5s looks as if it's done in here, right? So obviously against an overpriced 5s, 10s, this would be a reasonable storyline to start working long 2s, 5s against. You can see that storyline evolving there. Now, if that's in line with the 10s, the belly of the curve, the 5s, 10s, which it is, in line with that curve, absolutely. We could obviously start thinking to ourselves, well, if the 3s, 7s agrees with the 5s, 10s, the 2s, 5s will have to start moving. 2s, 5s will have to start moving. So it just gives you that extra, one little bit of extra confidence, which is maybe why Reeve was using the 5 7s, I think, whatever it was you said you were using, the 5 7s. So the 3 7s gives me a slightly better, or the 3 5s, gives me a slightly better look at how the movement should be between the 2s, 5s and the 5s, 10s. And obviously into the top edge, we can start recognizing when it gets a little bit above itself. Up here, for example, you can see it starts becoming a little bit exposed at the top print and a little bit exposed at the top print here. And they obviously offer opportunities to take a bit of business away from those areas. Now, if we look at those as tradable opportunities on something like the bond, of course, we can start looking at those as opposite reversals on bonds. If we look at these as sellable opportunities in bonds here, sellable opportunities here, sellable opportunities here, and sellable opportunities here, you can see that they capture the bond perfectly. If we look at these as buying opportunities in bonds here, the bond rallies, if we look at a buying opportunity here on bonds, well, it's into a high price, so you're going to be a little bit questioning that, but it still rallies, still makes you money. So we can see that these bond relationships are very, very strong. So if I go along to the right-hand edge of the charts now, so we can see what is developing, we can see quite clearly that we have had Fairly substantial divergence creeping into this in the last little bit of a short time. We can see that the divergence started to show up into the bottom print here. We can see that we get another extreme read down into the bottom edges here. And we can see that we get another pop down to the bottom edges again here, which just establishes the idea that we should be selling bonds on upticks into these areas just now, based on the fact that hopefully the 5s10s is still extending to the upside. Of course, that's very, very important to us, which the 5s10s is still extending to the upside. So that's all coming from the 10-year notes going a lot higher than you would expect, and it's having no impact on the back end of the curve at all. And we're starting to see some big block prints, by the way, coming in the 10s. Some very big block prints coming in the 10s at 13.5, isn't it? So that could be quite significant as we go into the afternoon. Some pretty meaty trade hitting. Anyway, so these are all buying opportunities on the 2s, 5s, which means they're all selling opportunities on bonds themselves, right? They're all sellable opportunities on bonds. Now let's take a look at the bond and see how it performs off of those sells. So you can see the bond sell comes in a little bit late, but it still sells off. The bond sell comes in late, but it still sells off. The bond sell sells off of a pullback high, and it still makes money. And a bond sell, still making money. So those 4 trades all made money based on that 2s, 5s, 2s, 5s, 3s, 7s narrative, in line with the uplift that we're seeing on the 5s, 10s belly of the curve. So should make a bit of sense, guys. Should make a little bit of sense. So if you have it on your charts, if you see the green line on the charts, you'll know what it is. And if we look at that in terms of the bigger picture, you can start to see some of this very, very obvious draft into what looks like a very, very good short bond trade. And that short bond trade is still making money. I did sell that 13 actually on the way out of here. There's the trade there, and the reason being was because we started to see some order flow coming in the short side of the book at that stage. So you can see quite clearly how easy it was to get that short, and you can see there's some order book selling coming in. There's that big block we saw in the 10s coming in there at 13.5. The 10s dropped down to 12.5 since then. So you can see that big block sell up here, and that short bond at the top edge doing quite good business off of the 12s, 13s down to the 6s. So quite an easy storyline to understand, quite an easy storyline to take trades against. And it's an extra line. If you want to put an extra line on it, might mean absolutely nothing to you because you've already seen it in the 2s, 5s and the 5s, 10s. But it's up to you. It just can give you that extra pause. That's sometimes what's missing from a lot of you guys in terms of your trading, is that ability to just be a little bit more patient, waiting for the trade, because the difference between the 2s, 5s and the 5s, 10s is significant, right? The difference between the 2s, 5s and the 3s, 7s is not significant at all, really, because it does overlap. And that allows us to make a far better read as part of that trade. It just, as I said, allows you that little bit of patience. You can see whilst it's still bearish here, we're not overcommitting to the trade here. And it's really just this phase here that we've started to really commit into that short bond trade, because the back end has got everybody now with us, and the front end of the curve has nobody on side. All the deserters have now jumped the sinking ship, and they've all joined the bandwagon on the steepeners. And you can see obviously that's left the 2s, 5s isolated in here, so that's fair enough. All good? Well, partly all good. Why do we say partly? Because something's still not right about the break-evens. We're obviously going to be watching this cash open now and seeing if the break-evens, the new break-evens from the US session, have a different story. And for me personally, they have a better storyline starting to evolve already. And this is what we're seeing here into the cash open. The curve looks good for that short trade. It looks very strong. The break-even since the cash open look as if they're now filling in behind that as a sell trade off the higher prints. And that's confirming that overall shape. That's what I was looking for, and that's what I've now got. So I'm quite contented now with that short bond trade. I'm quite happy to try and let it ride See if it's got any more for me to the downside and see what happens. We said we'd take a look at some of the bits that we covered in classroom yesterday. We asked you yesterday to pay attention to spikes on the highs, lows. And the reason why we asked you to pay attention to spikes on the highs, lows was because even on the hourly charts, even when we took ourselves up into these hourly charts and we started to look at these spikes, these became, obviously on an hourly chart, you can see where the extremes and highs and the extreme lows are very easily on an hourly chart. That's the good thing about the hourlies. And what we identified with these spikes was quite significant. What we identified was that these spikes, on the basis of the size of the candle, these kind of spikes here, and we can obviously see the highs and the lows from the other day into this top edge here at the price just there into the top edges. We can see these highs and lows, depending upon the time of the day, really do represent some tradable opportunities. When we're looking at an individual candle, what happens next on the next candle? That's all we're asking, remember. When we look at the S&P during those periods, of course, we can obviously start to look for the tradable opportunity that rests behind these candles themselves. We can see into the low price here, it's the closing bell. What happens the next day? The price goes up. Into this closing bell here, what happens the next day? The price opens gap down, but it does drop off a little bit. Into this opening bell, the price rallies. And then this was into the closing bell. Well, now obviously into the closing bell yesterday, the price obviously opened gap up and it did rally and it rolled over a little bit. Coming into today's market, it's dropped off just a little bit here. So we want to always pay attention to spikes. We want to pay attention to new highs. We want to pay attention to new lows. And we want to be able to see it. We want to be able to read it. We want to try and get a bit of a read against those areas. Let's take a look and see how this morning has developed. First of all, did it spike to the upside? Well, the answer is yes, it spiked to the upside. So we're obviously already aware that perhaps any type of divergence could be a sellable proposition. Is it a real spike? Well, if we look at all of yesterday's business, it's certainly a lot more punchy than it was before. So that could be a very, very bullish day that's forecast, but obviously we're aware that perhaps all the buyers are already in quite early. So we've just got to be aware of it. Now, do we have any individual candles that are developing here? Let's take a look at the 15-second. Remember, we took it down into the 15-second chart. What we're trying to do is we're trying to tie in the 15-second chart with the likes of the Prem. So let's take a look at our Prem. When we look at our Prem here, one of the things we've already recognized is we want to try and trade the Prem when the line is going in the opposite direction. So if I start looking at the Prem at the early stages, we can see that we definitely have this selling phase coming in. We see there's a very large up candle here. That would be a reasonable proposition to work short off of that candle. It spikes, it drops. This would be a reasonable proposition to work a buy, sell again here and again here. As the price rolls off this, you can see that the Prem starts to roll back up again. So you're looking for a reasonable candle to the downside to buy into. Now, obviously, it rolls up. It doesn't roll too far to the upside. We have this opening test, which was rejected. So I am net bullish. Anytime you draw the opening test, guys, there's the opening test. Why is it not an opening drive? Because it never carried on. So this is an opening test, which is actually bullish because it rejected that test. So when I draw that open right there, I am now a buyer of the market at that stage. Does that make sense to everybody? Mike will know this because this is an old-fashioned, I'm not saying Mike's old-fashioned, but you get the basic idea. If you've been around long enough, you've probably seen the opening test drive narrative many times. And the opening test drive narrative is all based around that type of story, isn't it? If this is the open and it goes south, well, that's an opening drive. That's bearish. That's just bearish, and we can simply recognize probably this is going to be a top edge for the day, potentially. If we see an open coming in here, we see the price driving down, and and it can be almost pinned almost straight away, or it can be a candle like this. It doesn't matter. If that's what happens there, that's the opening test. There's the test. They're seeing if there's any more sellers before they take the market bullish. This makes the market bullish at that stage. And you should obviously always be aware of the fact that this is an opening test to the downside. Now, sometimes it's easier to see that because sometimes it does this beautiful little candle right at the open, depending upon your time frame of reference, of course, where the candle just looks like that and it goes straight north side out of that, and that's the test area there as well. So that's your opening test, and that's your drive. The drive is the buy that comes in after it. The drive is the buy that comes in after that. So there's the opening test. It sells off at the open. It could be an opening drive. We don't know until it does what it's going to do, right? But when it comes back up and it goes through that, that's now telling us that that was now a test. They were looking for selling. They never got any selling. So they're now really bullish. So you've got to be aware that this is a bullish looking market for the time being, and that this is now the possible day low right here. Possible. Unless there's a fundamental change to the markets, this is now your day low. That makes this buy candle very, very, very good. So when you see that price coming back into that area there, you can obviously start to recognize the opportunity to make an awful lot of money. The Prem is now driving higher. We can see the Prem driving higher. We can see that developing quite nicely. We can obviously understand the highs, lows was also net bullish. It was driving down, but it was net bullish. We can obviously look at the tick. We'd imagine the tick is going to drive lower into that bottom edge. It does drive lower into that bottom edge. That's okay. We can live with that. And obviously all we have to now do is pick up the stops, look for the imbalance coming in perhaps for a seller, look for the imbalance coming in on the sell side, buy against that imbalance when we see it getting absorbed and flipped, and then take the market bid at that stage. And sure enough, we've gone from 40.70s to a high price of 40.77s. The opening test is when the open tests the lows and then rejects. It's an opening drive lower. It doesn't reject that drive. It drives lower. That's the difference. Make sense, Miguel? So any open that rejects by going back above the open, this becomes the test part of the phase here. They've tested for liquidity just to see what's available here. Just to see what's there. This is net bullish. Now, obviously, we wait for the bullishness to show up. I mean, it's not bullish when we get these candles. So when the price drives down, we're obviously going to be hoping to try and get the bottom edge because there's going to be a lot of liquidity in there from the test. So there's the bottom edge. There's the liquidity. There's your buy trade there, and that's the takeaway. That's the best takeaway you're going to see. That's how you trade these opening tests. It's the same way as we trade some of the opens on the momentum cats as well. When you'll see if you're a cats trader, an awful lot of the times that when it opens, it'll be opening gap up, of course, and it starts selling off. And as soon as it starts selling off, the buyers absorb it in reverse. Now, obviously, if I change this from a 15-second chart to a, for argument's sake, a 2-minute chart, look at the difference between that opening test candle. Do you see the difference, Miguel? Does that now look like the perfect test candle? See the difference? It's a beautiful pin rejection candle for that opening test lower. There's the open. There's the test. Pin rejection. There's the drive actually coming away from that area. And that opens the door to this being your levels. And that opens the door further to this being a perfect buy trade right there. So the opening test is actually this price here. So that's the open, that's the test, but the opening range is now this range here. And that becomes a great level for you to buy against because this is the decision's now fully made at that stage. the market should be bullish, and if you can find a buy trade in these areas, that's usually quite a safe bet to take a bit of business against that. And obviously drilling down into these smaller time frames allow you to see some of those opportunities. You can see a little level 2 liquidity getting grabbed just in here on these two pin rejections here, and then again here. That could have been an opportunity for you to join in, and this little test here would have been perfectly reasonable to take advantage of just there as well. And that's all you're looking for, these little rejections of something. Remember, it's a rejection of something. It's a rejection. It's a look at whether there's any sellers at lower prices. If the sellers at lower prices, if you start picking up business at lower prices, bearing in mind that that SPX level of 4070s might bring in some liquidity as well, but it didn't. And it gives you a better idea about how the market's going to evolve from those prints. We can start looking at the volatility guys. We're obviously bullish at the open. The volatility guys are bullish at the open. That helps, doesn't it? So if we look at the volatility dudes, what they think of it, you'll see that they are predominantly buyers at the open. You can see a very, very strong bullish response into that opening test, and a very, very kind of easy ride off the bottom prints as well, which was nice. Pretty easy, pretty clean trade opportunity for anybody. Good. Well, good enough, guys. Good enough.